want an exposure to a market or an
Everything they need in one place.
The world's foremost authority on individuals, advisors and institutions.
Hello and welcome to Morningstar. I'm Emma Wall, and here with me today is John Pattullo, co-manager of the Henderson Strategic Bond Fund. Hello, John.
Hi.
So we're here today to talk about three fixed income opportunities. What's the first you have for us?
Yeah, the first one is so-called legacy tier one bonds. So we hold quite a lot of the old style junior banking bonds, which were issued many years ago. The interesting thing about these is they're using their regulatory capital. So they're not loss absorbing under the new regime. So if a bank goes bust, generally these bonds have to, the new bonds, the loss absorbing bonds, either get turned into equity or get wiped out. These old bonds, that doesn't happen to. So the banks are keen to buy these back, but we're not that keen to sell them back to them, and hence they trade very well. They're very sought after. We've locked in some great yields with reasonable maturities for the clients. And the recent sell-off of the so-called COCOs, which are the new bonds, these bonds didn't really sell off at all, which is great because they're quite yieldy and not volatile. So we think these are very attractive, still got some merit, but they're maturing slowly, but they're quite hard to come by because most people like ourselves have got them locked away for the clients.
So this is sort of a supply and demand story then?
Yeah, very much. These things, there's no new supply of these things. Some are getting bought back by the banks, which is fine, but it's up to us. So we want to sell them back and at what price. And frankly, we'd rather just keep them for the next 5 or 10 years to the benefit of our clients.
And what's your second opportunity today?
Yeah, the second one is mobile phone convergence. I'm sure you've noticed that your 3G is probably not great. Whenever you travel, 4G is getting there. But generally, the European regulators are sympathetic to some or many mobile phone markets moving to a 3-player market, whereas in Europe, generally most countries have 4 players. So we've noticed this trend in Ireland, in Germany, and potentially many other countries. The regulators are sympathetic for market repair, it's called, because essentially the operators have to invest in 4G. We all want 4G, we all want data. Someone's got to pay for it. And generally when large investment grade companies buy smaller, high yield mobile phone businesses, their bonds trade up, as you would expect. And we've been very well positioned in that trade. And I think that's a global trade which could continue for many, many years. Telecom convergence in Europe is a hot topic, as is global convergence. You're also seeing quite a lot of convergence of cable TV businesses with mobile phone businesses and vice versa. And there's always been the third, which isn't our third one, but the third trend of the convergence with content as well. So ITV, for example, is well-rumored bid. So that's interesting as well. So the convergence in mobile phones, I think, is highly topical.
We've already seen that a little bit, haven't we, with the forming of EE, T-Mobile and Orange coming together. So that's just the start, isn't it?
No, exactly. And Hutchison Whampoa, who own 3, are rumoured that they may actually consolidate even the UK into a 3-player market. It's not happened in the States. Sprint was looking at buying T-Mobile. That's not been around the regulators. In 5 years' time, I think there'll be 3 players in the States as well.
And then your third opportunity today? Yeah,
the third one is actually a rather dull one. It's like stick to the knitting. We're quite late in the credit cycle. We don't want to get carried away. We don't want to lend to the latest over-leveraged buyout. So we're very much trying to stick to good, reliable, sensible businesses. And we have there's a rule of 3 theme where many industries consolidate down to 3, not just mobile phones. And a good one is motorway service assistance in the UK. So the AA and RAC, I would suggest, are pretty similar organisations. I'm sure they would hate me saying that, but essentially they are. And we actually lend to both of those organisations because they don't compete on price. They are an oligopoly, not competing on price, competing on brand. Both are well run, both are quite levered, both are well managed. Perfect bonds in our opinion. So we lend, one's a loan, one's a bond, but it doesn't really matter. But if you can get an industry which is heavily consolidated, competes on brand and not price, as a bondholder, you shouldn't get many surprises and you should get a good coupon for your investors.
Plain vanilla investing?
Yeah, well, just sensible. I mean, to be fair, those companies are quite levered, but the stability of earnings is the attraction for us. And I think that's what we're trying to do. We know it, we understand it. Some of us are customers. We kind of get it, and I think that makes a lot of sense at this time in the cycle.
John, thank you very much.
Thank you.
This is Emma Wall for Morningstar. Thank you for watching.